Hello and welcome back to our YouTube channel. My name's Neil Kane. Today I'm going to be talking to you about how charitable giving can really help transform your retirement strategy. So, we're going to be discussing some ways that you can be charitably inclined in retirement. But the first thing you got to think about is really what are you trying to impact? Are you really trying to impact your legacy by leaving these charitable donations behind? Or are you trying to match that generosity with a smart tax strategy? And a lot of times, those can potentially work well together, but sometimes you'll find that even if you're charitably inclined, you may not get that maximum tax impact unless you're smart about your strategy. So, we're going to talk about being smart about that strategy. But first, let's start off with a really important update that the TSP got this year, which is in plan Roth conversions. Now, in plan Roth conversions might sound very attractive and exciting to a lot of folks that are currently working. But keep in mind, if you do not have, let's say, heirs that you're planning to leave assets behind to, converting a lot or much of your TSP to Roth may not be in your best interest, especially if you plan to leave some of your, dare I say, TSP traditional retirement funds that are IRAs to charities. Why? Because charities don't pay taxes, right? So if your net goal is to leave beneficiaries on your TSP and some of that to charity, you would not want to convert that to Roth because essentially you'd be converting something to Roth and paying taxes on up front that would have been able to be left to those charities tax free as opposed to paying taxes up front on a conversion. So let's give that an example. Imagine if you had $100,000 that you were planning to convert, and in that scenario, you're paying those taxes up front. Those are lost tax dollars that could have ended up going to the charity, right? Because in a charitable donation, whether it's done directly or whether it's done when you pass away via method of a beneficiary, there is no tax bill on that. Charities do not pay any sort of taxable income when receiving donations via a retirement vehicle like a traditional TSP or IRA. So, in reality, the person who is excited about the Roth conversion coming to the TSP this year that wants to leave some money to charity would not want to convert their entire TSP or retirement plans to Roth in that scenario. You would want to leave some behind so you could leave that to charity taxable, but then at the end of the day, the charity receives it tax free, right? So, what are some of the methods that we can give to charity? Well, the first way is we give to charity directly, right, by stroking them a check. In that scenario, we give, let's say, money to a charity in terms of getting an itemized deduction on our tax return that will lower our income. But in some scenarios, there are clients that have a very high standard deduction, $30,000 plus for joint couples, where a donation to charity really isn't going to apply to lower their taxable income because it's not greater than their standard deduction, right? So in those scenarios, we got to think outside the box. One way that you can think outside the box is by doing a qualified charitable donation from your retirement plan. The caveat there, though, is you have to be 70 and a half years old to be able to do that. And in that scenario, you can donate up to $100,000 a year directly from your IRA to charity. And it counts really as two benefits or three benefits, really. One, it lowers the required distribution that's going to be asked for you in your mid 70s from your TSP or your IRAs. It's going to be excluded from taxable income. So it's going to reduce that RMD, which is taxable income, and it's going to be excluded from your income, whatever you donate to the charity. And the charity is going to get the full amount without any sort of tax requirements from that donation. So it really is a beautiful way to give money through the power of the QCD process. And again, that's 70 and a half years old requirement minimum age to do that, $100,000 limit, and zero tax impact on your taxes or the charities. And it lowers that required minimum distribution, right? And it could be especially valuable for folks that are in this standard deduction usage. They're not itemizing their taxes because the QCD has really nothing to do with that. You're donating those pre-tax funds over to charity, and they're basically treating that as after-tax funds. Okay. Other ways that you can donate to charity are through the use of donor advised funds. Think of this as your own charitable foundation that you've created through the use of basically a brokerage account that you're opening up with a financial institution. You can contribute cash by writing a check to a donor advised fund, but better yet, you can donate securities. And by securities, I mean highly appreciated stock would be a fantastic choice, or highly appreciated mutual funds or index funds like ETFs. Why? Because if you sold those funds to raise cash to then stroke a check to charity, you would owe capital gains. That would be silly. So in this case, you would donate and contribute those directly to your donor advised fund. You would sell those securities there. There would be no taxable event there. And then from there, you can give those donations to those charities on your own schedule. But the beautiful part about this is by being able to make this more so lump sum donation into this fund, you're likely going to get a much better tax benefit, especially for those that are maybe taking the standard deduction, because a lump sum benefit will likely exceed that itemized, that standard deduction as an itemized deduction, right? So if you donate $50,000 of highly appreciated stock to charity, that's $50,000 of the charitable itemized deduction on top of mortgage, interest, taxes, property taxes, and those things. So it's perfect for someone that's in a high income year. We had an example last year of a client who got stuck with a big tax bill because their mom passed away as the second beneficiary to the father in terms of a TSP inheritance. The TSP did not allow for a stretch IRA for this individual because this TSP had passed down twice from father to mother and now from mother to son. In that case, the TSP disallows the stretch IRA rules for the 10-year rule. So this individual got hit with a large taxable income hit from this inheritance. What we did was we donated just enough of securities that this person held in their brokerage account to reduce them off of the 32% tax bracket and keep them within the 24% tax bracket, because they were very unhappy they were going to the 32%. So these are ways that you can get creative around your charitable strategy, and ways that we can help you coordinate either now or in retirement, right? When you're utilizing your retirement income, you've got your annuity coming in from the federal government, you've got now Social Security, you've got these TSP withdrawals that are taxable, that are required, right? These are ways you can reduce the impact of this income hit, right? And again, by donating securities to avoid capital gains is a way to kind of bring it all together. So really, as we end today's video, we really want to focus on reducing that tax bracket in retirement, reducing income to keep folks within Medicare brackets, rethinking converting everything to Roth and leaving some in traditional plans for charity, and then just kind of simplifying that estate plan, leaving pre-tax dollars to charities, leaving tax-free to your heirs. So again, making sure you align that generosity with a smart tax strategy is really what we help our clients do. We are certified financial planners on our team, and we also have a very strong tax knowledge and tax department behind us that helps us with these decisions. So please, if you have questions, want to meet with one of our advisors, you can schedule a one-on-one by going directly to our website, which is retfed.com/register. Or if you're just not there yet and want to check us out on some of our YouTube content coming up, follow us, subscribe to this channel, like this video, and we'll send you out some more videos over the course of the next few months so that you can learn independently. So I hope you found this useful. Looking forward to seeing you all on our next YouTube video. Thank you.